Welcome everybody this morning to our first installments of our webinar here today. If I could ask that everybody mute their computers, and make it easier for the presenters to see them. If you can hit escape, if you're on full screen mode, you go to the top of your screen, and on the top where it says everyone, you scroll down and you just clicked on view presenter, view who's talking. So if you want to do that, you'll have a better viewing pleasure for this. So my name is Jordan Weiner. I'm the owner of JCW Title, but I'm also the Industry Affiliate Committee Chair. For those who are not part of GBAR, GBAR is the Greater Boston Association of Realtors. It is the largest local realtor association in New England and among the top 25 in the nation. We count for more than 10,000 residential real estate agents, brokers, and industry affiliates as members in our territory that includes 64 communities in Eastern Massachusetts. Now, I'm the chair of the Industry Affiliates Committee, and we're proud to present our first Giving and Getting webinar. This is going to be the first of many that we all hope that you can be part of. So thank you very much for joining us here today as our initial kickoff. During this meeting, we'll be presenting different ways the GBAR industry affiliates are staying involved and giving back to the community during COVID-19. Consumers and realtors will be getting more information about how home lending and mortgage transactions have changed in the last 6 weeks. Before we get started, please mute yourself, and to view options and choose who's talking. Feel free to show your face once we start the Q&A portion. So first off, we have Deb Frank from Metro Credit Union, and she is going to show us how to make a face mask at home. So Deb, I'm going to let you take it away from here.
Thank you so much, Jordan. Hi, my name is Deb Frank. I'm the Vice President of Mortgage Business Development at Metro Credit Union. I'm also a longtime GBAR committee member. And like many of you, I was looking for a way to do something to feel like I could give back during this time. So one of the things I came up with was making some masks, because that was something that a lot of people were doing and there was a big need for them. And of course, Governor Baker did sign in to law that we now have to wear masks to enter public places. So that's what I'm going to teach you how to do today. So what we did is we used a lot of old t-shirts in order to make these masks. So this is a GBAR t-shirt from an old event in 2018 that I'm cutting up and I'm going to repurpose into a mask. So I'm going to assume that you have a sewing machine and you know how to use it. So the things that I'm going to need are, of course, your t-shirt. You're going to need a ruler. Or
hey, Deb, can you just pause for 1 second and make sure that your camera is on?
My camera is on. Okay. I thought my camera was on.
All right, Deb, you're ready to roll. Start it again.
So, I'm sorry, I didn't realize that when Jen switched things that she switched me off as well. So again, we're going to assume that you have a sewing machine. We're going to use a repurposed t-shirt. This is a t-shirt that GBAR had from the 2018 Realtors Run. So the other items that you're going to need a ruler or a tape measure. You're going to need a Sharpie or some other kind of a marking tool. You're going to need some pins, and you're going to need a really good pair of scissors. We also need a way to be able to create a tie around your ear. I had been looking for using elastic. Elastic is pretty hard to come by. I've looked for various kinds of twines and strings. They're difficult to come by. Some of them are hard. Some of them feel uncomfortable. So what I ended up finding was clothesline. Clothesline has an inner piece that makes it hard, but you can pull it out and the sides are really soft. So that's what I ended up using. You can use whatever it is that you can find. So the first thing I did is I used a cardboard box, so a gift box, and I cut out a template that is 9 by 7.5, just so that I could use it in order to be able to measure. And then what I did is I took our t-shirt and laid it down on the table, right side in, just the way that you would wear it. And I used our template and our Sharpie to mark where it is. So you're just going to mark it. And these are mostly medium t-shirts, so I can get about 4 masks out of them. So we're going to mark our place, our t-shirt, and we're going to then cut it out. So I'm not going to cut it out for you, but when you cut it out, you're going to have two pieces that look like this. Okay, so there's two separate pieces. We're then going to mark the pieces for the pleats with our Sharpie. So to do that, you're going to measure from the top using your ruler 1.5 inches from the top, and you're going to mark that. 1.5 inches from the bottom, you're going to mark that. You're going to go an extra inch on either side and mark that, and an extra 1/2 inch on either side and mark that. So you're going to do it on both sides of the material. And then we're going to turn it inside out because that's how it's going to be sewn. So we're going to turn it and we're going to match it together on either side. Okay. Then what we're going to do is we're going to stitch the long sides 1/4 inch. So I just stitched down this side and I stitched down this side. And then you can flip it inside out. So now you have what will be the outer piece of your mask. So now what we're going to do is we're going to pin the pleats, and the pleats were what the markings were. So to do that, all you're going to do is fold down the first line to the second line, and you're going to pin it. And you're going to do the exact same thing, the third to the fourth, and the second to the third, and the third to the fourth on both sides. When you're finished, it's going to look like this. So it's going to have pins on either side. You're going to have pleats in it. You're then going to take and press this a little bit so that it's flat and it's easier to work with. After that, you're going to take that same piece and you're going to stitch down the sides, just to tack them down on either side with your sewing machine. So now you can remove the pins, but it's attached. After you do that, then we're going to take the collar piece from our t-shirt. So this particular piece here, we're going to just cut out, and we're going to use it to be our sides, which will hold our strings. So our sides, this is our collar piece. We're just going to stitch it here on either side and stitch it down twice so that it's solid. And then you're going to take your scissors and you're just going to trim it and clean it up like that. And trim down anything in the back because you've stitched it down. And the really cool thing about t-shirt material is it doesn't ravel really easily. So then you're going to do that to both sides. And when you're done, it's going to look like that. And it's going to have an end on both sides. So then what you're going to do is you're going to take your clothesline and you're going to cut out about 24 inches. You're going to measure 24 inches out. And you're going to fish that into the side, just like that. And then when you're done, you're going to pull that hard center out I mentioned, which comes out really easily, and it makes this really soft. So when you're finished, and Jordan, we're just about done. When you're done, you're going to have a mask that you can put over your face like this to cover yourself. It's pleated. You can tie it behind your head if you choose, or you can tie the sides so that they fit your ear the way that you want it to. Put it in, tie the other side the same way.
Perfect. Deb, how many of these have you made so far?
So far, I have made 672.
Okay, well, that's good. So let's take a break from you real quick. I'll let you kind of finish that up, the finished product. We'll come back to real quickly. But next, we're actually going to move over to Kathy Harney from Gentle Giant. Kathy is in charge of community relations for Gentle Giant Moving. She serves as an additional resource for realtors and their clients and the company, and does outreach to various realtor groups and real estate professionals. Gentle Giant is a longtime affiliate member of the Greater Boston Association of Realtor, and I'm very excited to have Kathy in her presentation here today, which I think everybody here is going to not only enjoy, but I think also use this service in the near future. So, Kathy, I'm going to give you the floor to take it away.
Hi, everybody. I'm here. Let's see. share my webcam. Hold on. Okay, hi, everybody. Kathy Harney here from Gentle Giant Moving. During this crisis, just checking in about what we're doing year round. We help Move for Hunger. Any customer who's moving with us that wants to donate non-perishable food items, we have a certain box set aside, and we gather that up and bring it to the Greater Boston Food Bank or whatever food organization is in the area of that office. Right now, we are not taking donations from individual homes, understandably, but what we are doing is providing transport for organizations to get their donations to the Greater Boston Food Bank, or helping certain organizations get extra food from Greater Boston Food Bank to their organization. So basically, I have a little PowerPoint that I can share with you. And if you can you all, hopefully you can all see that. But basically, it just shows some of our movers now all masked up on every job. And yeah, so this is Move for Hunger. It's a national organization. We work with them in all of our locations across the country. We have 12 branches in New England, but we're also Brooklyn, Philly, Washington, D.C., Lorton, Virginia, Charlotte, North Carolina, Fort Lauderdale, Seattle, and San Francisco. And the non-perishable food items are what we normally deliver. And then Greater Boston Food Bank delivers it to their local food pantries, or the food pantries come and get it from the Greater Boston. But now we cannot accept donations of cans from a household, but we are doing dock-to-dock transport. So it changes every week, our availability, what we can do, but we have standing organizations that we are helping right now. And that's a donation that we had done in Boston at the Greater Boston Food Bank. So we're doing what we can to help. And let me stop showing the screen and go back. Yeah, so it's crazy times, but we're doing what we can. And I love Deb. That was a fantastic mask tutorial. And I'm hoping I can get a recording of this to show to all my friends that are asking. But that's pretty much it from me. I'm happy to take any questions or anything at all, however that would work. But that's it for me, Jordan. Thank you.
Great, thank you very much, Kathy. And I'll allow, when we do a Q&A, if anyone has any questions they want to post, if you want to stick around and answer those for them, that would be great. But we'll also share some information after this with all of our guests here today of also how they can be a part of your great cause that you guys are doing. So let's just swing back over to Deb. Let's see this final product that you have for us right before we get into the getting part of the seminar. So Deb, how are we looking? Ta-da.
Do I have visual as well?
Deb, you look great.
Yeah, so here we go. And I actually have little dangles because I chose to tie it rather than put it around my head, because I hate things tied around my head. But I wanted to take a minute to let everybody know that I want to thank all the first responders, the grocery store workers, everybody out there that is chipping in and taking care of all of us, because without them, we would all starve. We need them. So thank you to them, and wear your mask, stay safe, to the best of your ability, stay home.
All right. Thank you very much, Deb. And like I said, we'll give some more information at the end of this to all of our guests of obviously how they can make their own masks at home and that old sewing kit. So now the mortgage professionals in our committee would like to give you more information on what's going on in the lending world. And this is what we're calling the getting part of the Giving and Getting seminar series that we're doing. So the industry affiliates is made up of several professionals in the real estate industry. This includes realtors, attorneys, lenders, home inspectors, title insurers, title examiners, and more. And together we identified some useful facts to help realtors and the consumers. And we're going to speak on this session, we're going to stick closely to the lending sphere of the affiliates. So first I'd like to introduce Nancy from Citizens Bank to discuss how mortgage timelines have changed.
Okay, great. Thank you so much. And Deb and Betsy, great job with all that you're doing to help out. Definitely appreciated. I love the masks and I love the charitable donations for food. I really appreciate what you guys have done. I have with me, I'm not sure if you see, Claudia Carr. We're in the office today, kind of getting almost back to work, but just a few people in here. But we've been tremendously busy over the last few months as interest rates started to dip, in December and January, but through March and April and now into May, they've been very, very low. So, just in general, not specific to Citizens Bank, but in general, I'd say a refinance transaction is taking, between 45 to 90 days, depending on the type of transaction it is, the ease of access to the property, and the type of appraisal that needs to get done. As far as what's really probably important to most people that are on this call today would be, how long does it take for a purchase transaction to get to closing? And, based on the technology that most mortgage companies are operating at, so much of it is already done online. And we've really all stepped up our game as to what we can do as far as uploading documents from the consumer, to our sites, to the banks. And some of the lending practices have been a little bit easier to get through. So for example, on some transactions with Fannie Mae and Freddie Mac, which are the two largest buyers of conforming loans, they'll allow different types of appraisals to happen. So we can get like a PIW, which is a property inspection waiver. We can do a desktop underwrite, which the system underwrites the value of the property, or possibly a drive-by if we can't get into the property. And it varies from lender to lender on what's acceptable. It varies on the type of product. So once you go into what they call the jumbo space, a loan over, 510 and then 690 for the conforming, the top of the conforming limit. If you go into the jumbo loans, it's up to the individual lender on what they're going to allow. And so some transactions you can get away with not having to do a full appraisal, which has been awesome. So, and I would say this is a general rule of thumb, that every lender out there is expediting purchase transactions. So we've seen transactions close in 20 days. We've seen them close in 30 days. And so, and Claudia writes a lot of business for Citizens Bank. So, she's had the experience of being able to just, get a loan through the system pretty quickly with very little pushback from the operations part of it.
We're really seeing between 20 and 30 days. It depends again on the appraisal. Some cases it's longer because if the appraiser has to go out there and they're slow, but that's typically in more rural areas. But for the most part, I'm seeing 20 to 30 days because purchase business comes first at Citizens. That's really important, is to take care of our relationships, the customer. So again, the 30 days is probably more the average.
Right, and that's pretty much an industry rule. Like if you talk to any lenders, especially all the ones that are on this committee, they'll tell you that the purchase transactions are the ones that take top priority in operations and underwriting. And it makes sense. A refinance is going to take a little bit longer. So the timelines are, pretty much based on how quickly we get the appraisal back. And the appraiser and the AMCs are also expediting purchase transactions. So, I think things have gone incredibly well. We haven't seen a lot of people pulling out of transactions. We see people that were engaged in the process going through with it, closing on time, very little pushback, and a lot of realtors, as you guys know, are out there still selling because we're doing a ton of pre-approval. So I think real estate is really what's going to pull the economy through, like it has every time there's been a crisis. I think that this is going to be a great year for real estate. I think we're going to do a lot of sales, and I think the banks are teed up technology-wise to handle it. Thanks, Jordan.
Great, thank you very much, Nancy, and definitely I think we're all very positive thinking that real estate is definitely going to be the tool that's going to get us out of this. So we're going to move on to Rick Betancourt from Caliber Home Loans, and a question over to you, Rick, is lending overlays. What has changed?
Well, I want to thank everybody for letting me come on, and it's been a pleasure. And I think what you've done, Jordan, here is awesome, and I love the affiliate committee with GBAR. So what you're seeing right now, this is kind of catered towards our real estate professionals that are on our call today. If you're a loan officer watching this and you're not sure what an overlay is, I would recommend you go talk to your manager, because that's pretty standard in our business. But for our real estate professionals out there, it's ever so important now to learn a little bit more about the other side of the transaction itself, whether you're as a listing agent or buyer's agent. Kind of learn a little bit more now about the nomenclature, about what the mortgage business is and our overlays. I think, in my opinion, the days of just working with particular lenders because they're your buddies or whatnot has really kind of fundamentally changed. You really got to be conscientious about where you're going to put your consumer from a finance standpoint. So overlays, what they are sort of they are layers of credit risk mitigation that lenders will put on there to address certain types of issues that have arisen in the mortgage business. One of the things that we've seen right away, first and foremost, is an increase in the minimum credit score requirements on a lot of our government loans, FHA, VA, USDA. Every lender has overlays. If any lender says they don't have any overlays, they're really kind of not telling the truth. And case in point, VA never created a minimum credit score, but every lender has a minimum credit score for a VA loan. So therefore, that's an overlay. I can tell you that we've increased our minimum credit score from 580 to 620. So that's an example of an overlay, right? So the credit score restrictions and a variety of different government lending programs and benefits have been one of the first pieces that we've seen as far as the overlays go. So as an agent, you want to be asking your mortgage professional, what are the credit overlays that you're working with on our FHA, VA, and USDA? You may have a borrower that's on the lower end of the credit spectrum, and you need to find somebody they're going to work with those particular borrowers in that sphere. I wrote a couple of these down too, because I want to make sure we try to hit on them. Income use, a lot of restrictions and overlays right now on income use due to the 30 million people that are unemployed. You want to ask your lenders, hey, what kind of income restrictions are you using? Some lenders are reducing self-employed income by a percentage and or adding in the requirement to have reserves, 6 months, 12 months reserves. So employment and income restrictions have been added overlays to the loan programs that normally would not be there, but due to the mortgage market disruption, liquidity, lack of servicing, sort of enticement, they don't want to buy the servicing rights. That's kind of what happened with our mortgage business. So they're throwing out their income restrictions to mitigate risk on certain self-employed transactions. It's one of those things that it's relevant because so many self-employed businesses are going to be impacted by the 30 million people that are out of business. Not only, the self-employed business owner itself is going to have some issues, but those out there that have lost their jobs, they're not going to want to use the services of specific small businesses. So that's been a big problem that we've seen out there. We're seeing that some lenders are not allowing rental income in certain multifamily transactions. You want to ask your lender that. I've heard some lenders are not allowing the rental income to be used unless there's a 12-month, 6-month, 3-month, 9-month reserve in liquid assets by the consumer. That's a huge overlay. So you want to be asking your mortgage professional, if you're working on a multifamily transaction, what kind of overlays do you have on multifamilies and rental income used to qualify for that transaction? So that's huge. We've seen reserve requirements go up. If there's an overlay before of a 2-month reserve, a lot of lenders have increased them to 4 to 6 to 8 to 12. It depends on whether it's a government loan, FHA, VA, USDA, conventional, multifamily, is it a jumbo? And like some of my peers here are saying, when you're in that jumbo sphere, that is completely whatever the lender wants to do. If the lender says I want 24 months reserves, they can have 24 months. If they were at 12 before, that's a huge overlay as well. Program restrictions as well. Another set of overlays that we're seeing, where the Veterans Administration Home Loan has temporarily suspended all VA renovation loans. We do VA reno. Not a lot of lenders are doing those in New England prior to, but now they've stopped them altogether across the US. So that is a huge program restriction right there. So when you're talking about overlays, that's just a kind of the 4 major big parts of the purchase transaction, or as a listing agent, you need to be mindful. This mortgage market disruption has forced a lot of lenders to sort of pivot due to liquidity issues and therefore minimize the risk that they're going to take. And they've done that by the addition of overlays. So listing agents, it's okay to call up that mortgage professional, me or Deb or anybody, and say, hey, this is a multifamily, what are your restrictions? You might catch a loan officer off guard, or you might just be doing a great job for your seller to make sure that you've met, you've done your due diligence. Buyer's agents, you want to have sort of a re-interviewing process with your mortgage professionals that you've worked with in the past. Some lenders have a high appetite of risk, some don't have a high appetite of risk. So therefore, you got to really kind of think about who you're working with. And I think also from an overlay perspective, you want to ask, are you servicing loans or you're not servicing loans? Are you selling loans or you're not selling loans? Because in the end of the day, where we put our consumers moving forward after this crisis is going to be, I think, there's been some interesting articles out there about permanent, semi-permanent, and temporary transitions or changes to the lending industry as a result of COVID-19. So from a buyer, from a real estate agent's perspective, you just need to do an interview process with your mortgage professional and ask about all the different overlays. Because I got an update at Caliber, 23 pages of modifications or tweaks, so to speak, to our lending programs that we offer. And I'm pretty sure every lender has gone through the same thing.
Great, Rick. Thanks a lot for that great information. Now we're going to go and move over to Deb Frank from Metro Credit Union. And the question to you, Deb, is going to be breakdown on changes relating to verification of employment prior to closing. So Deb, I'll let you take it away on that.
Thanks, Jordan. So prior to COVID-19 and the changes that were made, there were always verbal verification of employment requirements. It used to be they were done within 10 days of the note date. So within 10 business days of closing, we had to do a verbal verification to ensure that the person was still working. Since COVID-19, there have been some changes to that. So for the changes are agency specific. In some cases, they're lender specific. If it's a bank, they have portfolio products. But the basic guidance now is that verification needs to be done within 5 days of closing for a Fannie Mae loan. In some cases, they're doing verifications the day of closing. It really just depends. So a verbal verification does not necessarily have to be done. In lieu of that, we can have a written VOE that comes directly from the employer's work email address. Fannie and Freddie will both accept that, so long as the borrower's name, employment status, and start date are on it. Sometimes Fannie is allowing post-closing VOEs. Metro is not permitting those. I don't know other lenders who are at this point. They will also allow a pay stub showing year-to-date earnings on it that is provided within days of the after the most recent pay period. They may allow bank statements that show your deposit if it's within the last pay period. For someone who is self-employed, we need to see a continuity of income. So the closing departments are going to verify that the business is still active. So if the business is a restaurant, for example, there might be some additional proof required that you're doing carry-out business, that you're maintaining your income. So verifications of employment, verbal verifications are becoming more difficult because more consumers are out of work. So please be very careful because the rules are evolving. They could continue to change. And I would certainly expect a verification, verbal verification, up to the day of closing.
Okay, that's some good information. A lot of good changes. Qualifying a buyer maybe a little bit higher between what the preview have already said. So it's good definitely to contact your lending professional. Now we're going to go on to Betsy Bogia from Fairway Independent Mortgage. And Betsy's going to talk about understanding mortgage forbearance. There seems to be a lot of myths floating around that are misleading to the consumers. So can you talk a little bit about what those myths that you're hearing and maybe some truths about it? So Betsy, I'll let you take it away.
Okay, there I am. Hello. Oh, now I lost myself.
We all see you, Betsy.
Can you? Okay, well, anyway, hi, thanks, Jordan, and thanks to the other panelists. This is really helpful information, so I hope everybody's getting a lot out of it. So yeah, forbearance. As everyone probably knows at this point, on March 27th, the CARES Act was signed into law, and that included language allowing for forbearance, which is a temporary postponement of your mortgage payment that will need to be paid back. So I just want to say up front that this is really a solution for people who are in really desperate situations. You know, some of the things that we've seen, and I'm a marketing person, so some of the things that I've seen marketed are, you know, this idea that, you know, you should buy a house and just go into forbearance. You know, buy a house because you won't have to make your payments for 6 months. And that's just, you know, there are ramifications to this. There's also information around repayment when you go into forbearance. So we really want to be careful about, you know, what you're seeing. Some of the facts are the CARES Act applies to government loans. That's Fannie, Freddie, USDA, and VA loans. And it's up to 12 months of forbearance right now. But individual servicers are also coming up with their own plans for forbearance. So it really depends on who you're dealing with. So it's important that the consumer is talking to their servicer. And for clarification, most of us may understand this, but your servicer is who you're making your loan payment to, not necessarily where you got your mortgage. So it's when you pay your bill every month, who are you paying your mortgage bill to, and that is your servicer. If you're trying to contact your servicer to discuss forbearance or other options related to your loan, the recommendation is that you go to their website, because most have information there and have online forms for contact. Phone wait lines, wait times on phone calls are really long, so it's recommended that you do that. One of the things you want to be careful about and let people you talk to about forbearance know is scammers come out of the woodwork. Unfortunately, we're in trying times. You'd like to think that has everybody's best interest at heart, but there are those that try and take advantage of people. No one is going to contact you directly about forbearance. That is a conversation that you need to have with your servicer. So if you get emails or phone calls and people are saying, hey, you know, I can tell you how you can suspend your mortgage payments, or you can go into forbearance, or someone else can take on the payments for you, don't let people follow through on that. This is a borrower proactively reaching out to their servicer to discuss this. The real concerns about forbearance are how you pay it back. Because again, this is a postponement of your payment, but though your mortgage payment, your taxes and insurance are still being made on your behalf by your servicer. So it's not like those payments just went away. Someone's paying that bill for you and someone's going to want the money back. So the big concern is if you go into forbearance for 6 months, at the end of 6 months, you may owe all of those payments on the 7th month. So you want to really be careful, read thoroughly what the terms of your forbearance are before you sign anything, and understand what's the expectation once you come out of forbearance, how you're going to repay this. You can discuss a loan modification, which would allow for some of those repayments to be worked into your existing loan, or to be your loan payment time to be extended, so you're making those payments on the back end. But again, this is a really important conversation to have with your servicer and to really understand what the terms are. The other thing is, while the CARES Act says that you can't have an impact to your credit report in the moment, you won't incur late fees, there's no delinquencies being reported, and of course there's just suspension of foreclosure right now, you still want to keep an eye on your credit report, but you want to be understanding of the long-term impacts on your credit. So once you come out of forbearance, the guidelines, as far as I know, aren't clear. One of our other panelists may have more updated information because new information is coming out at the time. But from what we know right now, the long-term impact could be that following forbearance, you may not be allowed to apply for credit of any type for up to a year. So that means a car loan, a credit card, refinance, So again, you really want to understand what the ramifications are completely of going into forbearance before you make the decision to do this. So, you know, again, I encourage people to really educate your clients, to really educate yourself, to talk to your lender. What are your, you know, guidelines around forbearance? Because lenders are being very careful when dealing with borrowers if they know someone is going to go into forbearance. So, you know, you really want to make sure that your borrower is on solid footing. I shared with Jordan, the CFPB put out a really helpful one-pager that talks about forbearance that can be shared after the call. And if you have clients that aren't clear whether their current mortgage is with a government backed with Fannie or Freddie, if you go to their website, you can answer some questions and they'll let you know. So that's it for me, unless people have questions or.
Yeah, sure. We'll wait till the Q&A to see if they have any questions. I want to ask you at the end, but we're going to do about 2 more responses from the team. So Rick, I think we're coming back to you for this one. There's a lot of noise regarding some lenders getting out of the jumbo market. So can you briefly explain what that means and what does it actually mean for the industry as well?
Yeah. The jumbo market itself has always been a very unique sphere in the mortgage market space, and one that local community banks have always had a bit of a better handle on that. Generally, they'll service their own paper, they'll maintain the servicing on that. So in our county, Essex County, Middlesex County, Suffolk County, generally any loan amount that exceeds $690,000 will be considered a traditional jumbo. Those loans itself, from a financial perspective, have very thin margins. They're not very profitable for lenders. So when the market disruption began, when we started seeing a lot of unemployment figures come out on a weekly basis, what you saw is the end investor. So there's multiple steps behind a mortgage transaction, right? So there is a lot of people behind the scenes, more so than just a loan officer, a processor, and a closer, that continue working on the transaction after that. And they create this particular pooling of loans. The loans are pooled in a 100 million, 50 million. It all depends on the investor itself. Those are then traded or sold to end investors for profit for the lender that originated the loan. It's kind of like you create something, you sell it, you make money for that, and it comes back. The appetite for the end investor to purchase those larger jumbo loans essentially just shriveled up. We at Caliber have temporarily suspended all of our jumbo loan programs. Our CEO, Sanjeev Das, who brought Citibank through their crisis, just decided it wasn't something that we wanted to do right now. Now, I spoke to a borrower yesterday that was working with a local credit union that got a phenomenal jumbo rate. So it's not that it's gone, it's just that
Hey, Rick.
certain lenders are.
Yeah, I was just going to say, to your point, it's Nancy Mambocat. To your point, some of the banks are still able to go ahead with the jumbo financing, and we have a portfolio, that we use, and we service our own loans. So we're actually able to lend outside of selling to, a Citibank or a Wells Fargo or a Chase, some of the larger. Yeah. So there's still opportunity for the jumbo business out there, the larger loans.
And just like I was saying, Nancy, that certain banks have decided to continue in that sphere and maintain lending opportunities for those jumbos. So it's but I think we can all agree that the number of investors out there, or lenders, non-banks or banks or brokers, whatever you want to call them, offering the jumbo loans has dwindled significantly in the last 5.5 to 6 weeks. So there's not as much opportunity, I would say, if you're a real estate agent and you're working with a borrower in that jumbo sphere. I would encourage that borrower to do a lot of shopping. Due diligence is important here. Encourage your buyers to get 3-4 loan estimates from 3 or 4 competing investors that are lenders that are offering the jumbo. I think you'll see a wide variation in rates. You may get a higher rate over here, but a significantly lower rate over there on your jumbo loan, simply because the investors have a lot, like I said earlier in my previous presentation, appetite of risk. And I think that, will the jumbo sphere come back where more lenders are back in it? Yes, I do. But right now, I think as a buyer's agent or a listing agent, again, everything is all about communication and due diligence. You just need to spend a little bit more time than probably you were pre-COVID, asking about who's doing the jumbo financing, what kind of overlays are there, because investors on the jumbo program are putting overlays. Are there reserve requirements? Are there DTI requirements? Is there a change in the self-employment calculation? So, but the jumbo sphere unequivocally has experienced a major disruption, but no, it's not dried up, but there are not as many lenders now offering.
Great, thanks, Rick, for that great information. And like I said, every lender's doing kind of something different during this whole entire time, so it's good to get a little bit of information from everybody of how obviously we can all best serve our clients. So I'm going to kind of open up this last one to all the panelists that we have here today. And the question is limiting risk to buyers, narrowing the window between mortgage commitment date and the closing. So if you kind of each want to just jump on for about 1 to 2 minutes of what your thoughts are on of narrowing that gap between the commitment date and the actual closing.
Hey, I'm happy to jump on that, guys, and just say that, the narrower the window, the better it is for everybody involved in the transaction. As guidelines change, which, Rick was talking about, they come short time. They don't give us an extended window that's open that says, get all your loans in the next 3 weeks, make sure you lock them because we're going to remove this guideline. The changes come quickly. The GSEs, Fannie and Freddie, make their decisions quickly and change the guidelines. And you could have a loan in process that wasn't locked. They're not locked into that product. So get people to lock into a rate, lock into a program or product. And if they're able to buy the house, because we don't want people going into homes they can't buy because things in the marketplace have changed. If they're not able to buy the house, they shouldn't buy it. But if they're able to buy the house, you want them to close as soon as possible so that the guidelines for the loans don't change and the prices don't go up based on that. So that would be my take on it. The risk to buyers in pricing and in availability of product, like Rick talked about earlier.
I would chime in two pieces. Every buyer out there should be working with a real estate attorney that has implemented a COVID-19 clause or verbiage in their contracts to provide a legal out for them in a variety of different ways. I've seen contracts written so that even if the buyer doesn't feel comfortable with the current situation of their employment, they're allowed to exit the contract and receive all their deposit money back. So that's number one, as far as mitigating risk. And then to Nancy's point, as far as speed and efficiency, because of the guidelines change so fast, work with mortgage professionals that their companies are high on technology. Technology is what can get your transaction moved quicker through the process. Mobile app integration, JPEG, PDF integration, all those different aspects of the technology piece, which allows you to rapidly get your documents in, so that way you don't have to worry about a guideline change quick. Lock your rate. Don't cut your nose off to spite your face. Yeah, the rates are low, I get that. Don't kill yourself to try to wait for 1/8% from 3 1/4 to 3 1/8 or 3 1/8 to 3. It's negligible over the life of the loan. And if you wait, you run the risk, like Nancy said, of a guideline change and that thing being gone. Once we lock you into your loan and your program are locked, oftentimes the verbiage and the guidance will allow us to fund that loan and then be subject to the change. So I would say those are two pieces to mitigate risk and try to speed up the commitment date.
Perfect. Thanks, Rick. Yeah, definitely. And obviously, open communication, between the lender, the attorney, and the the opposing counsel and the sellers is always going to be beneficial for the transaction as well. So we're going to go into the Q&A portion of this. I actually just have a couple. I'll start off. Jenny, Aaron, I don't seen anything pop up on my chat. So if anybody wants to start chatting over to myself or to the group in your window of any sort of questions that you'd like us to answer. But mine, it's two questions. The first one is, our lenders on the forbearance, our taxes and insurances, are all lenders including those in the forbearance, or are those still going to be required? And I also want to ask, are there any other crazy myths or anything else that you guys are hearing out there of 0% loans for 30 years or anything like that? So I'll let you guys take it away.
Yeah, I was going to defer to Rick or Nancy to answer the question about forbearance and taxes.
So what we're doing, I can only speak for what Caliber's interpretation of the CARES Act. The only aspect of the forbearance which is applicable under CARES Act, our interpretation, is the principal and interest payments to our end investor. We service 90% of the loans that we originate, which means we go direct to Ginnie Mae, Fannie Mae, Freddie Mac. Those are the end investors for us. And we are still responsible to send the principal and interest payments. The borrowers, the consumers, homeowners, are still responsible for maintaining their property taxes and their homeowners insurance on their properties. So be very mindful of that. You don't want to not pay your taxes, and you definitely do not want your homeowners insurance to lapse.
And I would just say, in addition to all of that, that if you have the ability to make your mortgage payment, there's very little benefit to going into forbearance. So what happens when you even inquire about forbearance, it's going to show up on your credit report. When you apply for forbearance, it's going to show up on your credit report. And then when you're in forbearance, it's going to show up on your credit report. So it's going to be very difficult to move forward with a transaction if you've done any of those three things. And you can't really tell someone not to inquire about it because the rules may change along the way. So we are still accepting applications from people that are inquiring about it, are in forbearance, but it really makes sense to make the payment. The risk and reward on not making your payment is great. So make your payment if you can, is the message we're sending to people.
Now, is there any sort of penalty for getting a loan down the road if you do go into forbearance, maybe for only 2 or 3 months, and then everything's great for you financially? There are some rumors that you can't get another loan for about 12 more months.
I think that those rules are going to change as we evolve into the new economy and the new lending structure and how we transact. For right now, I think it doesn't impact your credit report negatively. However, Fannie Mae and Freddie Mac, if we don't sell that loan immediately to them and we wait 60 days to sell it, and during that 60-day period, somebody goes into forbearance and we sell it to them, then we get charged a big fee, like 700 basis points. So it's really important that we know exactly what's going on up front, so that we can make smart financial decisions.
I spoke with the executive director of the National Credit Reporting Agency. His name's Terry Clemens. He's a great guy, good friend of mine. And the credit bureaus are going to report whatever the lenders report to the credit bureaus. So it's really, you have to ask the investor where your loan is. At Caliber, we are currently stating that if you are in forbearance, you will not be eligible for a refinance unless you pay the outstanding forbearance in full, whether that's right before closing. We have not yet seen regulations or guidance on whether they could do it at a closing, like a refi. But we're not hearing of any sort of you're limited at 12 months. You can't get a loan for 12 months. I have not, and I don't know, I mean, Nancy or anybody else that's on that, I have not seen Fannie or Freddie issue guidance that you will not be able to get that sounds like an overlay to me. A particular lender mitigating risk may not want to extend credit, which is their total right to do so, for 12 months on a particular consumer that just came out of forbearance. That sounds more like an overlay to me.
Yeah, that's, that is the potential. We don't know. And that was the last I heard, that the guidelines are up in the air. So nobody does really know what that could look like. So.
Deb, you were muted on that one. Did you want to add to that?
Thank you. Yes, as far as taxes and insurance are concerned, there really hasn't been any advice yet given on how that's going to be handled. But keep in mind that your taxes are super lien, so they're going to have to be paid somehow. They just haven't given advice as to whether or not that's going to be part of the forbearance.
Maybe the first bill will be paid.
All right. So are there any other myths or anything crazy things that you guys are hearing that's going on during the COVID-19 that you want to kind of address as false?
There was a rampant rumor in the mortgage sphere that government lending was going to dry up in its entirety, FHA, VA, because of some liquidity issues that Ginnie Mae, that there was no appetite to purchase mortgage servicing rights, MSRs, for government loans, FHA, VA, USDA. I can say emphatically 100% that is not true. In fact, when Dave Stevens is a very well-known, nationally recognized mortgage expert. He used to run HUD, he used to run the MBA. He had a conversation with a large purchaser of MSRs, and because of the FHFA, and Nancy kind of highlighted this issue, the FHFA recently made changes to the cash out refinance delivery fees, where they're regarding forbearance, and it could be, like as she mentioned, a 700 basis point cost to lenders. A large MSR purchaser actually said to Dave Stevens, hey, I'm actually just going to start buying more Ginnie Mae MSRs or Ginnie Mae's mortgage-backed securities. So for those of you on here, VA, FHA, USDA loans are still viable. They're good financial opportunities for both veterans and first-time home buyers and low down payment. Yes, credit scores have changed a little bit in that sphere, and so hasn't some of the other overlays. But there was a few uneducated individuals out there saying that it was going to dry up April 15th or 16th, and that's just not true.
All right, perfect.
Right, and I would say the same for the jumbo piece, that, you know, the local lenders, the banks, so when you go to a Wells, the Bank of America, a Metro Credit Union, all of those companies are still doing the jumbo loans. And like Rick talked about, some of the overlays change, so the FICO scores are going to change, but they're still out there, they're still available. I think it's really important for the realtors to go directly to the source of that lender for those types of transactions, and I think that's going to make a difference for them.
I agree.
You know, really good information on that. So thank you.
All right, perfect. So, all right. So I'm not seeing any other questions in the chat box. So that just means I think we all did a good job at answering everything that we did here today. So I just want to thank our panelists here today, Nancy, Rick, Deb, and Betsy, for giving us a great information here today. And also thank you to Deb for showing us how to make these wonderful masks. And a huge thank you over to Kathy Harney from Gentle Giant for all the hard work you guys are doing. And I think it's a great cause. And hopefully that we can help support you guys with that endeavor. So this is going to conclude our first Giving and Getting seminar from the D-Bar Industry Affiliates. And I'm looking forward to having a whole lot more of these events down the road. So we're going to pass out some more information at the end of this. And I appreciate everybody that joined on here today. So hopefully everyone is staying safe and healthy and happy, and do your best for your social distancing, as we are all still essential workers. And like I said, thank you very much for joining us here today. So take care, everybody, and have a great day.
Bye.
Great job, Jordan. Thank you, everybody.